and welcome to IG's Charting the Market. It is Wednesday, the 13th of April, and so far we've had a busy morning. Now we've had a lot of data out, and we've also had an interest rate hike overnight. Let's talk about that first because we've seen the RBNZ hike rates by 50 basis points this evening, taking markets by surprise a little bit. Now, we had seen 25 basis points fully priced into the market. There was a big chance of a 50 basis points, around 70% had been priced in. But the statement coming out from the RBNZ really alluding to the need to have to combat inflation and have to do it right now. Their statement was showing definitely some hawkish momentum at present, but potentially a bit more of a dovish stance down the line. That's how markets took it at least. We saw the New Zealand dollar spiking up on the announcement of that 50 basis point hike, then coming back down and correcting the moves, finishing lower actually throughout the morning as we saw traders looking at the statements and realizing that the RBNZ had decided to hike 50 basis points now so that they could hopefully steady further down the line. That leaves a lot of doors open for other interest rate hikes. Another one to focus on today is the Bank of Canada. They will be having their meeting later on this afternoon. Now, markets are fully pricing in a 25 basis point hike there. But again, there's a lot of expectations that they will hike indeed 50 basis points, especially after the RBNZ. I think markets are now fully expecting that. Looking at implied probabilities this morning in the market, about 90 basis points priced into the market. So just off that 1%, we would see if interest rates were up 50 basis points from that meeting. So definitely a lot to look out for there in the Bank of Canada. Elsewhere, we've also had inflation data out from the UK this morning. CPI in March rising up to 7%. That is a massive increase. Markets were definitely not expecting it to be that high. Producer prices, retail prices also following suit, coming in much stronger than expected. If we're looking at the reaction in the pound, we did see the pound attempt to get a little bit of a move higher from that, but not much has happened. Inflation is a double-edged sword, and markets are now starting to digest that. Yes, higher inflation means more likelihood that the Bank of England will hike rates by bigger margins in their next meetings, therefore playing some supportive momentum there into the pound. But it also means that household spending is much harder. Households are having to put up with much higher costs than expected, and that alludes to these fears of an economic recession and an economic slowdown. And that's going to mean the Bank of England, as well as other central banks around the world, are going to have a really difficult job of balancing this persistently rising inflation with the need to watch out for economic slowdowns. That's enough for the fundamentals this morning. I'm pleased to say that today joining me is Serge Berger from the steadytrader.com, and he's going to be taking us through some of the charts that he's brought today for the market. Serge, welcome. What are you starting us off with? What are you looking at today?
Hey, good morning, Daniela. I thought we would just have a look at what I consider to be one of the more important charts right now. It's one of the most liquid markets in the world. It's the U.S. Treasury note. And I thought we would have a look at yield. We obviously had a big move in the CPI yesterday here in the United States. 8.5% was the headline print year over year. And not that surprisingly, we had a bit of a sell the news event in yields, meaning people coming in and buying some treasury. So basically what this is a chart of the 10-year yield note going back all the way back to the early 1980s. Risk parity trade has worked like a charm for a long time. And at this point, we're right back up to that upper end of again, we're looking at a chart here that stretches back to the 1980s. My bet here is that we're starting to see headline inflation from a rate of change perspective start to slow down. There's various ways of starting to look into this data. You can look at commodity prices, anything from some of the more actual consumable commodities like sugar and wheat and so on and so forth, to even arguably maybe oil. We are starting to see used car prices start to peak, and actually had the Manheim used vehicle index yesterday start to roll over. I think 6% over the past 6 weeks. That's actually a decent input part into the CPI. So I would argue that we're going to see lower yields on the 10-year probably well before we see anything higher, if ever, for the foreseeable future.
Yeah, a lot of market focus has been on the fixed income market to see how it's been behaving. We've seen those yields really picking up in the US, pushing the dollar higher. A lot of these currencies, the pound, the euro, despite having some strong fundamentals, pushing them or attempting to push them higher in the last few days, we have seen the dollar outperforming, and especially against the Japanese yen. What's your views there on the US dollar? Have you got any charts, or have you got any views on potentially any currency pairs with the US dollar and what we're expecting there?
I think breaking it down to individual currency pairs right now is a bit of a tough one, just because you have so many different inflation data prints, and they're all kind of a different time frame. So the U.S. has its certain point in the inflation cycle. Japan is another, if it has any at all, and the UK and other parts of Europe as well. So I just continue to be bullish the dollar on this sense. I think there's a lot of mismatch on expectations on this on the whole sort of weakness of the dollar. Ever since I've been in this business for the past 22 plus years, people are calling for the end of the dollar. At some point maybe that will happen. I just don't think we're quite there yet. And with yields getting more attractive and people maybe start to buy treasuries, we've seen institutional pension funds start to pick up their purchase of treasuries the past few months. So I'd just be along the dollar index kind of as being long as a basket against other currencies.
Great. And how about the equity market? I know you brought a few charts with you. We'll have a look in just a second. But we have seen quite some moves in the last 6 weeks or so on equity markets. We have seen some momentum picking up. There's a bit of support coming in. We have retracements, and we do see those buyers coming into the market. How are you reading this move in equity markets? And are you expecting them to continue to pick up?
Yeah, I mean, I think the equity market's at a really interesting juncture. So there's a couple of things that we could see happen. I think the path of least resistance for the very near term is probably still somewhat lower. One of the arguments that we continue to hear, and I had a fairly lengthy discussion with a few institutions yesterday, is why are equities holding up as well as they have, given what's going on in terms of not only general headlines, but also, of course, inflation data and what the bond market's doing. And what we are hearing, and it does kind of make sense, is that people are looking through this data, meaning they're thinking that the Fed at some point is going to just flip back to dovish, meaning basically not hike as much, or maybe even ultimately cut rates. In fact, the yield curve is telling us that. There's a lot going on here. I mean, the U.S. equity market, whether it's the S&P 500 or of course does something like the Nasdaq, is actually largely focused on a lot of correlation trades around basically a few equities, which is kind of scary in and of itself, but it is what it is. What I brought along here is just the Nasdaq 100, the NDX, and this is a daily chart. You can see a whole bunch of moving averages here. To keep it really simple, we had a lot of overhead resistance as we started to break below the 100-day moving averages, 200-day, which being the red line. And we found a lot of resistance there. So this is the very technical part of it. But overhead resistance is a lot different now than it was, let's say, at the COVID lows. Technically, why that's important is because the moving averages were actually upward sloping back in 2020. They are not upward sloping now. They're actually downward sloping. So I wouldn't be surprised if we retest the recent lows in the not too distant future here in maybe still the first part of April. I will say that from a seasonality perspective, and again, this is a bit trickier this year, but from a seasonality perspective, April does tend to be a pretty good month for U.S. equities, particularly S&P 500. So maybe very near-term bearish. Beyond that, I wouldn't be surprised if we start to see a bid come in again as people start to realize that ultimately the Fed will be more supportive than people think.
How about in Europe, European indices? I think you've got a chart there of the DAX. The DAX actually underperforming a lot of its peers. The FTSE has actually been holding the best here in Europe. What are your views on the recent moves in the DAX?
Look, I think for the DAX, it's actually not that different than what we just saw from the Nasdaq. I wouldn't be surprised we start kind of heading back down and revisiting the lows that we saw in March. It's in the mid 12,000s. There's just so much going on there still. Remember, the DAX and the German economy much more closely tied to the Russian economy, if you can still call that. a correlation, but certainly more than part of the U.S. markets and other parts of the world. So I wouldn't be surprised to see a retest of that 12,500 area. Technically, you can see the long-term chart here holds up real well. We have a lot of confluence of support, but support tends to be more of a pillow or a mattress where you kind of sink into it. So I wouldn't be surprised to see that kind of move again. Much lower than that, I'm not quite sure that is possible or is very likely, I should say, in the near term. It's probably more of a back end of the year story if we start to see the economic data weaken further.
Great. And just to finish off, let's quickly talk about commodities. And oil has been the star of the show for a while now. We do have Brent crude hovering near $105 per barrel. We've got US crude just above that $100 mark. Now, in my view here, we've got two conflicting forces in play, or a few, but we've definitely got conflicting forces. On the one hand, we've got EU sanctions on oil, Russian oil. This means a tightening supply. We've got OPEC not quite willing to bring in more supply to fight off demand. So we've got that on one side. And then on the other hand, we've got those concerns about a recession. We've got those renewed lockdowns in China. For me, what we're seeing in oils, we're just seeing kind of it move sideways, a bit volatile, but it's not quite deciding, are we yet at a price that's sustainable to continue growing, or do we still have some correction here in the market?
I think you're spot on. I think it's going to remain somewhat choppy. I think the majority of the move to the upside is probably done. The chart here, I think, is from a pure technical perspective it's a bit too easy to draw conclusions, because as you say, really the story with oil from the sources that we tap into on the research side for that really tells it's not so much a story of basically too much demand. There is an issue of getting this stuff out of the ground. And so it's an investment, it's a lack of investment in the space that we've seen, and they just can't get it any quicker out of the ground. So I would imagine that we're going to remain at somewhat lofty levels, looking at a Brent here. Anything, north of 100 to 150 is probably fair game. I think calling for a move to 200 is a stretch, but I also think calling for a move down below, let's call it 85 or so is a stretch as well. So I think it's a trading range, great for traders. Just be mindful when you trade this, you are aware of when the major oil data comes out, which is pretty much every day.
Well, thank you very much for joining me. That was Serge Berger from thesteadytrader.com. Join me back here at 4 p.m. to have a look ahead at what to trade in the markets tomorrow on Thursday, the 14th of April. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.